Right now, 20 cents of every tax dollar goes toward one thing: paying interest on the government's $39 trillion debt. The cost to service that debt is rapidly crossing $1 trillion a year, putting immense pressure on the U.S. financial system. The Federal Reserve is trapped right in the middle of this math problem, and they just made a highly divisive announcement about how they plan to handle it. The central bank's traditional focus on maximizing jobs and keeping prices stable is quietly shifting. They are now in a desperate scramble to keep the U.S. dollar from buckling under the sheer weight of these massive interest payments. Their announcement was a total freeze. Despite intense political demands to lower borrowing costs, the Fed is keeping interest rates exactly where they are. They refuse to cut them, and they refuse to raise them. This chart shows the trap they are in. If they lower rates, mortgages get cheaper. People borrow money to buy houses and start businesses. But when housing demand surges, prices go up. Cutting rates actively fuels inflation, and inflation is already running hot. Global conflicts in the Middle East are pushing up the cost of oil, which makes diesel, shipping, and fertilizer more expensive across the board. The alternative is raising rates. That fights inflation, but it chokes the economy. Borrowing becomes so expensive that the real estate market stalls, buyers dry up, and companies stop hiring. This exact dilemma has triggered a civil war inside the central bank. Half the voting members argue they need to cut rates to save the economy, while the other half insists they must raise rates to protect the dollar. Both traditional options lead to severe financial pain. The system is deadlocked, and it's going to stay that way until a massive impending change in leadership forces a new strategy. On May 15th, Jerome Powell's term as chairman expires, ending his direct leadership over the country's interest rate strategy. But Powell announced he will not step down from the 12-member voting board until an ongoing Department of Justice investigation is fully resolved. That means his strict anti-inflation influence stays in the room. Stepping into that divided room is the incoming chairman, Kevin Warsh, who operates with a highly contrasting economic philosophy. Warsh was appointed by Donald Trump, who has been aggressively demanding that the Federal Reserve lower borrowing costs to stimulate American business. This sets up a direct collision, an outgoing chair holding his voting power to fight inflation, going head-to-head with a new chair mandated to force rate cuts. To appease both factions, Warsh is preparing to execute a dangerous, untested economic experiment. Warsh plans to slash interest rates to stimulate the economy, while aggressively shrinking the Federal Reserve's balance sheet to prevent hyperinflation. He wants to sell their trillions in government loans to the open market, pulling cash out to counteract the lower rates. The flaw in this plan comes down to supply and demand. If the Federal Reserve stops buying U.S. debt, the government still has to find massive amounts of private lenders to fund their deficit spending. With fewer buyers for their debt, the Treasury has to sweeten the deal. They will be forced to offer higher, more attractive interest rates on their bonds just to convince people to lend them money. This chart details the ripple effect. Because lending to the government is the baseline risk-free investment, every financial product is priced against it. If Treasury yields spike, they drag everything else up. Banks hike mortgage, car loan, and credit card rates to keep pace. Warsh's maneuver could completely neutralize the rate cuts he promised, sticking everyday Americans with higher borrowing costs despite the Fed's actions. Warsh insists that private demand will absorb all this debt without rates going up. But he is already preparing 3 major rule changes at the Fed, just in case his math fails. First, he wants to abandon forward guidance, the Fed's practice of hinting at future economic moves. Second, he plans to reduce regular press conferences, leaving the public and the markets entirely in the dark. The third change alters the metrics entirely. Warsh plans to redefine exactly how the government calculates the official inflation rate. By changing the formula, the Fed can report a comfortable 3% inflation number on paper, while ignoring the high prices you actually pay at the register. If the experiment fails to stabilize the economy, their solution is to change the grading rubric so the failure looks like a success. As long as money is printed to service a $39 trillion debt, the hidden tax of inflation will slowly drain the purchasing power of your paycheck. Relying on a standard salary and keeping your cash parked in a traditional savings account is a mathematical guarantee that you will fall behind. The real rate of inflation isn't a government statistic. It is the raw cost of survival. the climbing property taxes, the insurance premiums, and the massive amount of capital required to buy a home. With the Federal Reserve overhauling their playbook on May 15th, you have to take control of your own financial education. You need to actively invest your money, or the real cost of living will price you out entirely.